So IFRS 16 has been in development for a long time. So we're talking about March 2009 was the discussion paper, and clearly all the way through this process the leasing industry has been quite vocal about they don't like this. And the reason for that is it removes what has been seen as an advantage of the leasing industry. So now it will be on balance sheet. Lessor accounting, that doesn't get impacted. So in the lessor side, you still have financing and operating leases. And the reason for that is lessors always have an asset on balance sheet. So whether it's a finance asset or a physical asset, there's an asset on balance sheet, and so people have not been that concerned about lessor accounting. It's really lessee accounting that's been impacted, because under IFRS 16, lessees will account for all requirements or all commitments under a lease agreement as an on-balance sheet right-of-use asset and lease liability. So simply put, what you're going to have to do from an accounting perspective is discount the future payments at an appropriate rate. That's your liability and that's your asset. Now, accountants in South Africa, in my opinion, don't battle with how to account for a finance lease. So the standard is not about complicated accounting. Most people know how to do that. They know how to do a discounted cash flow analysis. It's not that complicated. There are some issues around it that we'll touch on. But the issue is not that, it's around how, why, what it does to your numbers and where those numbers go. And that's really what we're going to try and focus on. So there are a few exemptions that we'll talk about. So if you look at the top right-hand side, they have said don't worry about short-term leases. Those are leases that are 12 months or less. Now clearly the one thing that started in that space is, well, how do I structure a lease to get into a 12-month contract? And the problem is, it is easy to do, but it's quite complicated thinking about the implications. Because if you want to use an asset for 3 years, you're thinking, I'll sign 3 12-month leases. Well, what you do have to assess is what's the likelihood of renewals being in play? And so if that's built in, so if, for example, you start saying, well, the first period of the lease is X at a price, the second one is cheaper, the third one is even cheaper, reflecting that it's an older asset, then we're going to turn around and say, but it's likely that you're going to renew, therefore it's a 3-year lease. So those are the complications on the one side. You can, however, genuinely construct a 12-month lease. So if you go to Eqstra and say, could you give me a 12-month lease, they'll give you a 12-month lease. But what you must remember is the asset deterioration for a lot of assets in the first 12 months is far more than it is in other years. So if you want a genuine 12-month lease, you're putting risk on the lessor, and they will price that risk in. So fulfillment of the lease contract has to depend on an asset, an identified asset, and the contract conveys the right to control the use of the identified asset for a period of time in exchange for consideration. Sometimes it's easy, you sign a contract that says lease on the top. Most of those are leases, and so they'll be in the scope. It, however, can get a little more complicated. If you're a ShopRite or a Pick n Pay, what the guys do is they put panels down the side of your truck in a lot of cases. And so you might not actually know what truck is going to be used. And you can't just go and say, in the contract it says these are the trucks with these registration numbers. I've seen those where the trucks are not used on that contract. They've identified them, but they never use them. They use other ones. And so as lessees, you actually have to understand in those sort of contracts how the lessor is going to do this. So it becomes a little bit of understanding the lessor's business as well. Clearly, you also have to understand some of the logistics around it. So if you take someone like Clover, who outsources their contracting fleet, and you see trucks going around with Clover on them that Clover doesn't own, some logistics company owns them. Now, depending what that company can do and how easy it is to rebrand that, because clearly if you take another milk company, they probably wouldn't be happy with their milk being transported in a truck that says Clover. So they might put that in a contract if they know that the particular company is servicing Clover as well. So you've got to start understanding. Now clearly, you can put petrol in a milk tanker. It goes in and it comes out. But the problem is when you put milk in after that, it's a little bit of a problem. So again, you've got to think through what are the consequences of this. What else could they use this truck for? And do I actually have an identified asset? So you've got to start thinking through some of these consequences of this. So that's one example. Clearly, again, if you are a specialized retailer, so frozen goods, and you don't want your truck to be used in the backhaul process for anything else, you might write that into your contract, that the truck can't be used for anything else in the backhaul. So it's going to come back empty. Now, clearly, transport companies don't like that, so they will charge you for it, and it would have to be specified in the contract. If you do that, again, it's likely you have an identified asset, because you're starting to say, I'm the only one who can use this truck. Okay, so you start seeing some of those consequences, and some of the things you've got to think through. So the easy ones are the lease contract. When it says lease on the top, that's easy. It's those contracts that are outsourcing contracts. You have to start looking through and say, are they asset dependent? So we've spoken about trucks. The other example is power. So if you have a solar panel, a solar plant built next to your premises to supply you with electricity, and you are the sole user of that electricity, again, there's an identified asset that comes into play. So you can start thinking through, the standard starts expanding the consequences of what is a lease. Now, this is not something that we have not dealt with before, but previously we weren't that concerned about it because a lot of those contracts would have ended up as operating leases. So whether you make the outsourcing payment the expense or an operating lease payment the expense, generally as auditors we were saying, actually if you just call it the outsourcing, we're probably not fussed because there's no real material difference on that. Now there will be. So again, any contract you've had assessed under what used to be known as IFRS 4, so the interpretation of what's the lease, that's going to come back and have a very close look at you. Okay. So your auditors will be looking at those contracts.